moderated by Purav Shah and a very interesting panel and a theme again, Venture Capital for Innovation in Private Equity. So may I please request Purav Shah?
Good afternoon, everyone. I hope you all had your tea because if not, we still have a good session boiling up here. If not, if you want to wait for us for 5 minutes, we can. Right. So, hi everyone. This is Purav Shah. Hoshira is my day-time job and my part-time job is an entrepreneur. So I wear both hats at the same time. At Hoshira Capital, we deploy funds typically in the pre-IPO space, as well as largely in the B2B consolidation and M&A space. That's where we focus on. Have been an entrepreneur for a while. Earlier Avatar was management consulting, and so here we are. We have a very exciting panel today. Can I please invite my co-panelists, Ankur, Dhiraj, Siddharth, Sumesh.
దేనికి దానికోసం ఏంటి ఫోన్
Thank you for joining us.
ఆయన చెప్పారు కదా
So there is a scene in a movie called Margin Call, a brilliant movie, where Jeremy Irons plays a character called John Tull. And just before the night when the ship hits the fan, and they realize that there is no turning around, everything is around. So he sits with his team and he says this: there are 3 ways to make a living in this business. Be first, be smarter, or cheat. I'm not saying any of these gentlemen here are interested in the third idea yet. But yet is the hook. So yes, but that line describes almost perfectly how the capital industry has evolved over a period of time. 3 capital types originally positioned where venture cap is for venture said we are first, we will be first. PE came in and said we will be the smarter guys in the room, whereas the sovereign funds guy came in and said you guys do whatever you want to do, burn your money, we will still be here. We are here for the long-term game. So it was very clean, very elegant, very textbook. But if India is anything into 2026, is it not textbook? If on a Kapil Sharma show you have the Sunicons and the Unicorns entrepreneurs invited instead of film stars and cricketers, you know the startup world has arrived. Am I right? Right. So 49 billion in PE and VC funds, $1 trillion fund setting up 4 to 5 billion fund in GIFT City, which is and a sovereign fund. Zepto founded in 2021 heading for an IPO, but guess who was the last investor? A pension fund raised out of some European country. So this is where we stand today. Everyone is in each other's lane, so to speak. The venture funds are taking the long-term bet, playing the waiting game for 10 to 12 years. The PE funds have suddenly started taking interest in deep tech, and the sovereign funds have come to India to invest in the IPO story. So where are we headed? And that's the best part of the conversation today. is thanks to TiEcon. I am not going to answer those questions these four gentlemen are. So the onus is on you to keep this conversation live and as honest as possible. I see Ankur smiling here. Yes. So I'll start with the intro. So Ankur Gupta, partner at Singhi Advisors, a firm with 36 years of institutional memory. Lived the full capital arc from angel rounds to Series C at Ecom Express to structuring Carlyle's platform merger and Bain Capital's billion-dollar partnership with Gupta Transmissions. He is the person who translates a founder's vision into language a PE fund will actually write a check for. So that's Ankur. We have Siddharth. Siddharth is founder and CEO of FirstLoop Capital. He's built a company, felt like what capital does to a business at 2 a.m. on a Thursday, then crossed the table to actually deploy it himself. And he funds founders before they have become actually obvious to the world. Then we have Dhiraj on the panel. Dhiraj Sinha, managing partner at SilverX Fund. Not just thinking about the company in front of him. He thinks about the fund mechanics, the LP on the other end of the board, and where this bet survives a 10-year horizon. That's what his next big thing is. He's just building a 800 crore fund. And finally, we have one individual here, the only person on this stage right now. Partially, you can also consider me Sumesh. He is co-founder and CFO of Cognida.ai. The only person on this stage living the consequences of capital decisions in real time. Everything these three individuals are going to debate, he experiences every Monday morning. So that's the panel we have. We'll start with a very quick 30-second question fired at you. No more than 30 seconds, yes or no answer is also fine. And then we'll get into some depth. And this is where my monologue stops. We will have more conversations. So before, venture for innovation, E for scale, sovereign for stability. Does that still hold in 2026? Ankur will go.
Yes, Purav. I still feel that each has its own way. However, things have changed. Lines have blurred. VCs have aspirations to become PEs. PEs have aspirations to become sovereign funds. So to that extent, yes, things have blurred a little bit, but the fundamentals remain.
Thanks, Ankur, for the wonderful introduction. Good evening, everyone. Thanks to TiEcon Vizag and the entire team for putting up a gala show. Absolute pleasure to be amongst all of you. And Ankur, thanks for that question because last 4 years we have Cognida.ai. We started in 2021. We did a pre-series, we did a Series A, and that's what my practitioners experience I was sharing with Ankur earlier in the day. I personally feel that lines have completely been blurred because of the sector that I belong to. The sector that we belong to is pure AI deep tech. We're not a services company, we're not a product company. We have our own platform called Zuno. And on Zuno, we build accelerators for our clients across. So we have about 306 people globally with 2 offices in US and 1 in Hyderabad. And what we have done, our experience in last 4 years was the exact question that he had asked earlier in terms of are VCs or PEs looking at the same traditional approach when it comes to big tech companies? The answer is no, because in our case, at seed level itself, we had the biggest PE firms in this world approaching us and willing to invest in us. Probably it was because of the fact that we started earlier than when OpenAI and all burst into steam, because we started in 21. 22 is when Sam Altman came and then the entire FOMO and AI euphoria happened. So because of that, possibly in my sector, I see this completely being blurred between VC and PE. Sovereign funds, something from Saudi Arabia and Dubai, they are still interested. but I have not had the Canada pension fund or Australian pension fund still coming to me. So, and family offices, mostly from Southeast Asia, they're most from my connect because I spend a lot of time out there, but otherwise, I would rather say VC and P lines are blurred because of the sector, but the other two are still gradually waking up to it. Because there's a huge FOMO in terms of what people are saying with NVIDIA, what people are saying with OpenAI. They all think that every company which has an AI in the tagline is going to be the next OpenAI and NVIDIA, which unfortunately is not so, because every company cannot go through that cycles because these guys are investors. These guys are not companies which have gone 3, 4, 5 years back.
Thank you. Dhiraj, a 30-second answer, please.
Thank you, Purav. Thank you, Kalyan Garu, for having me here. Lines are getting blurred. As you said, and as everybody agrees here. And as a VC, at the seed stage, we are also seeing that we also want to take a bite of pre-IPO deals. We also want to take a bite at early stage deals. But it's a model. It's the structure which is coming up, right? Because if you look at the entire funding cycle, we are seeing that there are lot much of capital, chasing very few scalable, companies, very few scalable, opportunities. So that's what is happening. When you start, VCs, PEs, and sovereign funds are all has a different mandate and a separate mandate. But when you have the very few companies, which are scalable, this kind of structure will follow in the ecosystem. So that's what is happening. What I feel.
Thank you. So I feel the whole game is layered. It's all about the capital structure. Yes, the venture risk is matured into growth capital already, which happened quite quicker than the values what I feel is here. But of course, the PEs or the sovereign funds, if you see, they are mostly investing on ecosystems rather than marketing or the popular narratives, rather than in e-commerce or in fintechs or these kind of startups. But PEs are mostly in infrastructure, AI infrastructure, or logistics. So they still have their own focus. They're investing on ecosystems and companies. But of course, VC are slowly becoming into a growth capital.
Right. So what I'm hearing here is the labels may be intact, but the lines are clearly being blurred, and that's a consensus we have had so far. So, and probably this is exactly what happens before the framework actually breaks apart. Because first it's the lines that get blurred, and then you start driving in each other's lane, and then you realize that, and then you start owning the lane. So that goes to, so then we'll go to the next question, and probably Dhiraj, you can take a lead on this. Has VC become P with a better branding? Venture capital was built on specific promise, early days. Fund the crazy bet, absorb the failure, wait for the outlier. But VCs are holding positions for 12-13 years. With 100 million checks not coming as a surprise anymore, especially even in the Indian market, because we are not even talking about the value. So has VC become P with a better branding? And once Dhiraj responds, I would let probably Ankur to comment.
I don't agree with the branding thing, right? If you look at the data, if you look at, I've been investing for last 13 years, from angel checks to pre-seed and now at the seed level. What we are seeing is that the check sizes are getting bigger, right? When we, 4 years back, probably the data says that average, seed check in India, I'm talking about Indian context, were around $1.8 million. Today, if you look at the last year data, the average check sizes has gone up to $3.5 million, right? So it has doubled in just 4 years. So the $100 million seed checks in India, will not be a surprise in the next 2-3 years because the kind of influx we are seeing. So VCs remains VCs, but now considering the Ps are entering into your lane, you also try to cut a larger checks, right? Like our motto at SilverX that we feel that our average check size will be 30-40 crores, but if somebody is doing good, we can go to 100 crores, which is directly entering into the PE lane as well. So branding will remain VC. We are still committed for 10 to 12 years time horizon with the founders. And that's why the motto is that the founder which I am selecting is I am ready to work with for next decade, right? That's the motto personally me and SilverX as well. But some of the opportunistic bets which will come across us probably will go into the PE lane. But the focus will remain a long-term bets. Whereas the PEs are like 3 to 5 years kind of a horizon.
My experience has been that private equities, when they raise money, they raise for a certain time horizon. They have certain return expectations. VC sometimes is more fluid. However, what we talked about here is that if there is a sector which is very interesting, everyone wants to jump into the bandwagon. And in Sumesh's case, where AI is the boom, they want to catch something in the way. And what happens is very often that the same private equity, it used to be Sequoia, then or VC, Peak 15 has 3, 4, 5 funds. So there are feeder funds, there are early stage funds, etc., which sometimes feel that or gives an impression that the lines have blurred. But the core purpose of the fund, at least for 70-80% of the deployment, can't change, in my view.
Yeah, sure.
Maybe there's also lines blurred between the founders and early stage VCs also. A lot of early stage VCs are also turning out to be operators in a young startup, right? I mean, so a lot of VCs are now mostly audacious or passionate. They're pseudo founders, right? So I think the PEs, as you said, mostly the ecosystems, and the VCs are working along with the founders in making or launching and then selling it out to a larger PE. So VCs are definitely looking forward to become a larger PE or to send this young company to PE as well.
Listen, sometimes it is compulsion as well. They need to give the continuity to the startup.
Correct. Yeah.
So, to expand on that, Dhiraj, specifically, you manage a fund and you're always on the clock. No fixed fund life as such, because as you mentioned, people are coming with the long-term bets. So, is the convergence that we are seeing between the VC and PE, is that just taking advantage of the opportunities right now and the FOMO between them, who is going to invest first, and timelines don't matter anymore? What do your LPs say? We'll ask Dhiraj first.
See, the whole market and the whole ecosystem in India, has matured in last 10, 10, 12 years. How we were seeing when we started investing and what we are seeing now. So, lot of domestic capital, is coming in, and with a long-term plan. A lot of family offices, a lot of corporates were putting money. When I started investing, I remember the data, says 2-3%. Domestic capital was around 2-3% into the Indian IFVC spaces. Today, I believe it is around 12 to 15%. So last 10 years, it has gone 6 times. The data and the projection say that probably by the next 5 years it will double and it will go up to 30%. So a lot of domestic LPs, lot of family offices, individuals, HNIs, they are putting in money into the Indian VC space, VC space with a long-term bet, right? So that is putting us, lot of VCs like us at ease, right? The clock, 8 to 10 years is just a perception, right? Because you are already doing 3-4 funds, series of funds, a lot of LPs are getting repeated. So, it is just a perception that you have to give return, create some liquidity. But today, if you see, the data and the other VCs, behavior, I think once you have the DPI 1, probably everybody is comfortable with it, which can come in 5-6 years also. And then everybody is happy if you keep on multiplying or keep on holding it. There are various, rolling mechanism available into the structure with the government, with the regulators and all. So the clock is just a perception which I have, which I feel is there. But people, at least from the Indian domestic market, people are there for the long term, and it becomes it makes things a lot of easy for us. Obviously, we are here to return because we have to return the hurdle rate and a lot of other things comes into the picture, and obviously the performance and the track record. But I have seen people happy to stay put for a much longer time as well.
Yeah, I'm sure at least three gentlemen here will agree that fund management fees, the carry, so they are absolutely happy when LPs say we are here for long term.
I'll put a disclaimer. Lot of fee structuring has also started happening.
Yes.
For us, if I can talk about SilverX, we are saying we are charging management fees only up to 5 years, not beyond that, because we feel that after that, probably we don't need fees of that kind of. Probably we'll charge a very nominal fees just to meet the requirements. But we are very clear that we are charging the fees only for the first 5 years. So just a disclaimer. For that, market has changed. Everybody knows what's happening. So management fees concept is probably also taking a bit of charge.
So any family offices here listening to this, please meet Dhiraj after the conversation. Yeah. Very there is an incentive here. So Sumesh, you have always been on the other side of the table, talking to multiple funds, multiple VCs. Does it actually matter for a founder, a VC fund, or a PE fund, or an institutional fund, or ultimately you have to develop the same presentation at the end of the month, whether it's a VC or a PE, on the performance and present it to the board. So what's your take on it?
It matters, but it doesn't matter whether it's a VC or a PE. What matters is what is the management philosophy, what is the investment philosophy of that particular fund, right? So we were, as I said earlier, we were approached by the biggest names in 2024 when we did our Series A in India and in US. Of course, we are in Delaware-based C Corp, so we always wanted US funds there. Both the private equity firms or the venture capitalist firm, when they approached us, our question was very simple, saying that, okay, what is it that you expect us to do? And we were completely transparent that we are building a platform. It is capex. We will not be able to give you EBITDA returns. If you're looking at returns probably in 3, 4, 5 years, it's not going to happen. Our dream is to go and public in US. So we were completely transparent with every investor who came in. What we realized was, and we raised money with an investor who did not give us the highest valuation as well. So that's because of the reason is the entire investment philosophy was not syncing up with what we were otherwise looking for in our investor. We wanted an investor who could be part of, need not have board rights, but if he's part of the board, he connects us to his network, he gets us our revenues, he gets us to the client bases, because we need a top line growth, who is patient with us, does not go with a time monitor saying okay, it's 3 years, 4 years, 5 years, and more importantly, something that I realized what we didn't want to catch any fund which was the fag end of its fundraise as well, right? So if there was a fund which started in 2019, I said okay, thank you. Anyway, you're in 2019, so I don't want to, just because we want to show somebody that we have also invested in an AI company, I'm sorry, we are not that company for you. So to your point, it doesn't matter whether it was a VC or a P, and frankly, it actually came out very transparently from their side as well, saying that look, this is what we are looking at. We are looking at a 5 years exit, we are looking at a 7 years exit, we are looking at an 8x multiple or whatever. Because if there is more transparency, the more there is a marriage that happens between the investor and the investee. For us, it was all about the quality of the investor, the network that the investor brings in, and whether he is in sync, he or she is in sync with what our growth aspirations are. Because finally, it was our own company, and we were only diluting about 18 to 20%. So doesn't matter. What matters is the investment philosophy and the investment thesis of these funds.
So I think what we hear so far is the real story isn't about what is capital types are called. It's about the incentive and time horizon. That's about where the most conversations happen. And one very interesting thing came out is even the founders, even the startups are selective in who they want to bet with. So, which is again a very interesting perspective. Clock anxiety, right? Is convergence maturity or pressure? Right? So a venture fund has a typical 10-year life. Management fees stop. LP patience runs out. So for a sovereign fund has no such clock. But a VCPE are eventually on a clock. They eventually have to show the returns. They eventually have to go from one fund to another fund and keep raising it. So, Siddharth, is the clock pressure changing the quality of decisions in Indian ventures?
Yeah, I think definitely, because there's a compromise. So if sovereign funds, it's 8 to 10 years, definitely a startup would need, if IPO is the goal, right? I mean, if it was 10, 12 years, 30 years. So when you, at one point of time, a sovereign fund will definitely look at EBITDA stability. They want you to not chase so much growth. Maybe they'll hold the founders accountable and show some PAT, then the EBITDA comes in. So that's when I think definitely startups, if that was the case in 2021 or 22, the season where we saw the highest capital being deployed by VCs, we would have been seen so much growth. So definitely a compromise, especially for the Indian market, if we are seeing sovereign bonds behaving that way. But I don't think a lot of VC right now, what we have is consisting of sovereign money. Yeah.
So I say this with a lot of affection. Indian ecosystem, Indian startup ecosystem, Indian founder ecosystem, and that actually translates to the capital ecosystem. We have our own personality. We have the Banya mindset with an enterprise goal. And nothing wrong with it. Again, I say it with a lot of affection. So, Ankur, when we have sort of established India is not a Silicon Valley, we probably do not intend to. Now, when it comes to unit economics, Series B, serious checks, typically you cut checks 300, north of 300 crores, 400 crores, the M&A deals. Does the fund structure change when it comes to cutting larger checks, going for a Series B equivalent? And how are we different in terms of deploying those funds, not just for the time horizon, but also for the success criteria?
The size there, is definitely, or scale is definitely different. 300 crore to 800 crore, or 50 million to 100 million dollar investment typically starts to talk about significant minority controlling stakes, that kind of language. And for them to have that kind of bandwidth, management bandwidth, to be able to become operators, to be able to take an active participation in their portfolio companies, then limits their ability to, let's say, 8, 10, 12 companies that they can invest in. So definitely in India, the scale has limitation, and to that point, the size of the check dictates what kind of a fund, can actually ride such investments.
So, have we become more cautious? Like 2021, 48 hours, you would have happily signed a term sheet. Am I right? And a lot of VC years would agree. But then came the infamous funding winter, and then 2022, 23 happened. But now we are back where founders and good companies are being chased by the funds. Has that correction made Indian capital genuinely smarter? Or are we still more opportunist about it, rather than looking at, is this a real good investment in the long term?
See, something that
And the question is open for all.
Yeah, but something I would suggest that we put 21 in context. 21 came after hiatus or a freeze of 2 years, where these businesses, funds had raised money, the clock was ticking, and they had to return because the IRR clock is always running. And in that haste, you know, a lot of businesses as well, business models were no longer investable. So there was only a small pool of businesses which were working in that period, you know, which drew investors like bees, right? And as Siddharth said, 2 hours was enough. You had to chase the founder rather than the founder chasing you. But yeah, you know, after that, things have cooled down and businesses are back to their usual. They have their investment window where they have to invest in 3 years, 4 years, 5 years. So everyone is back to their life cycle, in my view.
Dhiraj?
We can add a bit here. See, the good founders, good deals, good companies were being chased always, right? Whether it is 21 or 23 or 26, right? What has happened, as what we have seen, because we have done, early stage deals and we are still focused there, is that the 21 was the, golden run for the founders. They were getting the valuation they wanted or they were asking, and they were also getting the numbers what they were asking, right? So they were, if they wanted to raise a $5 million round at a $100 million valuation, they were getting both, right? What has happened now, in last 3-4 years is that valuation streamline has happened. A lot of FOMO also has gone out from the VCs, space, right? And we are all running, cutting each other. That has stopped. So now valuation has become streamlined. A lot of scrutiny has come around that, and also at the same time, the numbers what they are raising, the round size also has become streamlined. Where we are saying, do you need that kind of money, right? And and who will write you that check, and what will you do that, do with that money? So that sanity has come in, which is good for the ecosystem. A lot of founders have also realized that, last 18 to 24 months has been a good period for everybody. But good team, good founders, good technology were chased always, The sectors keep on changing. Like EdTech was where, being changed at some point in time. Now, nobody is asking, nobody is talking to them. Same thing is happening in AI now, and slowly, this will also, streamline. But we believe that the deep tech, is here to stay. We have seen the consumer products, market, getting a lot of valuation, creating a lot of wealth for everybody. SaaS has done that. Now we are seeing where SaaS is. But now I think next 10 to 15 years we see the deep tech is here to stay. A lot of money will flow, a lot of ecosystem has been created. Government is also putting a lot of support. So that, and for that you need larger capital, and that's why we come. We started this because we feel we're the right time where deep tech will require a lot of money and create a lot of wealth for the entire ecosystem. And we are happy to we have no shame in chasing good founders there as well.
Possibly a very slightly different perspective as a practitioner. You look at the data for last 3 years: 9 billion, 13.2 billion, 12 billion. This is the investment that's been done by VCs in India, right? Anthropic raised $30 billion 2 weeks back, right? OpenAI, $40 billion at a $380 billion valuation, and before that OpenAI did it. There was a sovereign bond that was released for $100 billion, which is like for 100 years. I don't think in India we'll have VCs or PEs having that kind of appetite, right? So the point that I'm putting in perspective is when we say, have they become smarter? Possibly the VCs, and they are the right guys to answer that. The so-called the risk that they saw in 21 with EdTechs and FinTechs and a lot of these companies going down in has made them little risk averse to make that kind of investment. And there's no point in investing in the wrapper companies. You need to go and invest in the infra companies, you need to invest in the data center companies, and that's what you keep asking, say that when will the next OpenAI come out of India?
That's a fantastic point. After all that has been discussed about server, the last round they raised was $41 million versus the 40 billion investment we are talking about. So
no, please add, who are the investors? 2 state governments. There is Orissa and there is Tamil Nadu, right? And these are points that we need to understand. If in Sarvam, which everybody talks about is India's answer to LLM, and we all made a huge show of it in the AI summit, asking Sam Altman saying that, look, we have an LLM. Where is the investment coming from? Why is no PE and why is no VC investing in that company? NIIF, There's an Indian infrastructure fund that's been done. Who is the investor in that? Temasek. What is Temasek? It's a GIC from Singapore. So that's the point I'm saying. So all the big VCs and Ps, where are they when it comes to investing in these kind of companies?
That's actually leading to the next round of the conversation that we want to expand to, where India is still investing where it knows what is happening. It is very cautious when it comes to what it doesn't know yet. And probably that's the deep tech story that we have today in India. And that's where I think we'll zoom out a bit. We'll talk about some of this. You mentioned Temasek, and you mentioned we talked about some sovereign funds. So three capital ecosystems have actually solved different parts of this puzzle, right? Silicon Valley built risk tolerance long back. Singapore built Cohort, GIA, Temasek, etc. And then Middle East came with the oil money, and they built what we call patience today. Earlier, everyone was rushing towards the VC and PE, whereas they were the only ones taking the long-term bets. Now, talking about deep tech, and we were talking about serverless, for example. Is India, first of all, is India ready to build its own Singapore? Is India ready to build its own sovereign fund, where you just mentioned again, who invested in server? It's the two states, right? Why hasn't a PE or a VC cut the first check? And that's where probably the fortune also lies. It's just that India isn't ready. So Singapore is 6 million people, and if you look at greater Visakhapatnam, probably is that size. But annually they cut $300 billion checks. When will we stop going to Singapore? And again, Ankur, I'll start with you.
See, in my view, India scale will be very different. The open-ended funds, which typically are proprietary funds or sovereign funds, they benefit, those kind of funds in India typically invest in capital markets and not private markets. Private markets have largely been either funded through closed-end funds, or they've been funded through prop money, or prop LP, large LP, which is bankrolled them again onto the next fund to provide that continuation support from the next fund. For a sovereign fund kind of a setup, where typically pension funds or state funds invest, insurance, that kind of money comes in, I don't think for the scale that we are still ready for such funds.
Dhiraj or Siddharth?
I think we'll reach there. We'll reach there. I think my guess is in next 2 years from today, we'll see $100 million seed checks coming in, right? And probably, you guys can hold me to that. But that's what we are seeing, the influx of money which is coming in, and if we reach the 30% of the domestic capital into the Indian VC system, we'll see that number coming through for sure. Now, I think Singapore is probably not the right example to give, and let's say Abu Dhabi or Dubai, probably not the right example to give, because India, is a different animal altogether, right? Every state is different, risk appetite everywhere is different. So probably will not see a large sovereign fund, coming from India, but probably you can see smaller sovereign fund from different states like AP, Maharashtra, Tamil Nadu coming in, and a lot of work is happening. So scale probably will be smaller, and India has been a smaller market compared to if you see US, and the global markets. But it will come. It will come soon, because a lot of appetites is being built, a lot of money is being put in, and government has also seen that 1 rupee from the government attracts, let's say, 5 rupees from the private market, right? So it will come, but smaller sizes in smaller sizes in scale is what my guess is.
If the new fund of funds, the 10,000 crore, is a good sign, right? I mean, government, especially government, wants to invest in AI, infrastructure. So that definitely is there, and India has a lot of talent as such. I am sure we can be a big wrapper marketplace coming soon, next 2-3 years. But I think the next 10 years will be for the founders who understands this capital architecture, like, you know, to whom to go, whether according to your company, whether to go to a VC, whether to go to a PE, or to a sovereign fund, or to a government, or to whichever, right? So the founders who understands the game of whom to approach and what to, how to, or one founder sitting and managing their investor is the whole, I think, such founders and companies will win the game, at least will take the first step. Right? And also for the smaller companies, even I'm looking at a lot of marketing capital is coming up in India, which is required. Again, when you go back 4-5 years ago, what of the VC capital which comes in India actually again rebounds to Valley as ad spends, Meta, you either, let's say you raise $20 million, you spend $12-15 million back onto a customer acquisition cost. You give to Meta or Twitter or whichever, right? So the money is coming from there and it's again going back. You spend, right? Which is understood. So that is being corrected, like Dhiraj and Ankur said. But there are a lot of marketing VCs and micro VCs coming up who are very cohesive, who work with the founders. That's that range. And in terms of the infrastructure, yes, the largest sovereign funds also it's a welcome sight.
Sumesh, I'll come to you.
Just one point burning on that. I think to your point, India is ready. India needs more success stories. Because that's where the confidence will come for these three gentlemen to go and invest there, right? You look at the Skywood, Hyderabad's unicorn. What is it incubated? It's incubated in TiHub. Right? It's a TiHub product which came in. And we need more examples like that. That's when people like them would at least have the confidence to go and invest in large infra companies. Nobody thought 10 years back that we would go and invest in a space tech. A sovereign fund will go and invest in a space tech. Today we have drone companies, somebody spoke about in the first half. We have space companies. More than $333 million have gone only in space tech last year in India. So India is ready. That's one answer.
We still have to invest in the ambition rather than the revenue.
So yes, a lot of we could do that conversations, but again, Sumesh, you can probably ground us here. When you have access to this type of capital, and when you have already raised decent amount of checks, when do you feel the pressure? Does capital add pressure to you, or it adds value to you? Because both are not seen in the same light. So when does what happen as a founder perspective?
That's a difficult one. So it definitely adds tremendous value because you need money to grow. We can only bootstrap, especially when you are growing in your growth phase and the kind of investments we did in our platform called Zuno, because we are not a services company, we had our own IP built in. First 3 years we invested more than $4 million. So that adds tremendous value. We also, for our Series A, we invested in the go-to-market, which gave us the arms and legs to get the top line. The pressure will come now, and that pressure will come when 1 year of stagnant growth or 1 year of degrowth, for whatever reason, there's so much of uncertainty happening in the last 24 months across. I mean, we have not been growing at the speed at which we wanted to grow because we all expected a 25%, 30% CAGR growth. Today it's in single digit for a lot of companies, including us. Pressure has not come in, but it will come in when we get to those single digit growth, when we get to stagnant growth, and hopefully the VCs with whom we have partnered with, they will understand because they're on the board. We have monthly board meeting. So far they have been extremely supportive, and they've not asked the questions which we all otherwise feel pressurized for. They've been pushing us for more growth. They've been pushing us to go and make those hirings. They said, don't worry, you guys have got the product. You guys have phenomenal customer base, client base. Just go for it. Don't hesitate and also. This is the phase that I am going in. So I don't know if the pressure will come in 3 quarters down the line. But if 1 year of stagnant growth comes in, I'm sure the pressure will come in because they're also at the end of the day people like that who would want multiples and growth and revenue multiples and all this stuff.
In wearing a VC hat, pressure is like maturity in children. It comes way before we think they are mature. So be ready for that maturity, that type of pressure, because you are getting matured faster. That pressure is also coming faster than you imagine. Now, in interest of time, I have been told that this would be the last question on the panel. So There were a few more, but what I so for you guys, we are going to do a very quick fire round where the legend is hot, which is a sector where everybody is investing, but you think that it's over investments or probably they don't deserve it. Cold is a sector where sectors which are being ignored as we speak, but you believe they are real good bets. And steel fish are sectors that you do not want to touch, or you, if founders even send you a mail, you are not going to read those mails. So and from a founder perspective also, we'll have your world perspective. So we'll start with let's Dhiraj, we'll start with the hot seat. So hot sectors for you.
Advanced material, quantum is something what we are looking at.
Again, hot is something which is, let me clarify, hot is something which is over-amplified as of now, or it's sort of a bubble.
Okay, so hot probably I'll say now a lot of AI companies which are being built is very hot right now.
Okay.
Right, and no offense to any founder who is there building AI space. Right, but
what about the cold part where you would like to invest?
I would like to invest in upskilling in the edtech sector, and we feel India is understaffed there. Right, so not the edtech, which is the conventional edtech, but a lot of upskilling opportunities still remains in that sector, and I would love to look at that sector.
And what's the stale fish for you?
Lending is probably for me.
Okay.
Highly regulated, very difficult.
Okay. Ankur, we'll come to you. Hot.
Hot, definitely, AI, part of AI, I wouldn't say complete AI, and also to an extent defense and, drones, for example. Some parts of that is just wrapper and creating use cases out of something which doesn't exist.
Okay. Cold.
Cold,
Which has been ignored, but you would love to invest.
We spend an inordinate time in manufacturing and industrials. That is an area, India is definitely benefiting from all, cotton comes and goes, but all the trade restrictions, etc. But India is definitely becoming the manufacturing hub for the world. So cold is, the brick and mortar businesses which have an opportunity to really scale up, really put investments in new technology, new processes. They're investing heavily in renewable, bringing their power costs down, etc., etc. So there is a lot of scope there for scale-ups and multiplier effects.
And what's untouchable for you?
EdTech, online EdTech, definitely. That's something that doesn't work.
Okay. Hot, which sector?
Okay. What I think one maybe PropTech a little. Still a lot of mushroom growth.
Be aware, you are in Andhra.
I know. Not much
The
of PropTech
system
happening in
is
Andhra, but yes.
And you are talking about PropTech.
Yeah, maybe little PropTech and AI maybe wait and see, right? Based on the pitch that we get. And the cold might be, I think MedTech, there's a lot of potential which, MedTech, MedTech. And somewhere I feel there might be a policy disruption again in India and the RMG might come back. So it's a very good time to maybe explore some RMG
Not many conversations happening actually.
I know, that's best time to.
And what will you not entertain at all?
Not something on my mind.
No, you have to be honest. Come on. We have to
Upskilling, we're interested, but EdTech, no. Yeah, upskilling, yes.
Right. Yes. Now, let's just mix it for others. You as a founder, right? Let us talk about what is hot capital for you, what is cold capital for you, and what capital you won't touch. I'm putting you in a spot here.
Okay, so hot capital would be a capital which comes with as I said, the investment thesis which syncs up with us, great network, great branding, that would be a hot capital. Since I'm changing the definition of hot, this is something that we want, not from a bubble perspective, right? So that is what we'll be very eager to, that's what we have gone through also during our series A. Cold capital would be, again, should not be saying, a lot of my relatives who have got a lot of money, they want to just come and say, okay, we wanted to invest in you, and it's not just cash, right? So when we look at capital, it's beyond cash. It has to be smart capital, because that's where we will be able to grow, that will be able to monetize that capital beyond cash, as I said, between the networks and all. And the fish part, if I have to do it, is basically any capital working, as I said, if there's a 2019 fund which is towards the end of it and wants to invest in us just to glamorize their investment portfolio or checkbox their investment portfolio, that would be still fish.
Right. So this brings to a conclusion for the questions part. We'll take questions from the audience. Any questions from the audience?
I got a question for Sumesh. So it's interesting that you said teach us like which investor to go. So right now we're being hunted by like 5, 6 investors to take the money, but we're scared. Like you don't know whether we should take the money, whether we should like do something. So for founders in early stage, like what are the critical signs that you have to approach somebody? What is the right way to not leave a strong message that these guys are not approachable going forward? Because that's a tricky situation we're facing right now. We can't say no, we can't say yes.
Yeah, maybe. It's a tricky question as well, right? So I think the loose part of it is basically, as I just mentioned, understand what the investment philosophy of that particular investor and what have they done. I mean, I would not go and raise money from a fund which has been investing in manufacturing. I would not go and raise money from a fund which has been in SaaS, because I can't meet those multiples of 8, 9 times of it given my gestation over next 6 to 7 years, right? I would want to understand where have they invested in the past, what is that fund, who are their LPs, what is the expectation in terms of the performance that they expect from us. And this actually happened in 24 when we were being wooed by everybody on the street. We said no to a very high valuation from a very, very renowned private equity firm. And the entire founding team was against me and my CEO asking, said, why did you leave money on the table? I said, the performance pressure. We didn't want to be another edtech company kind of a scenario wherein they give us $1 billion kind of a valuation and then they ask from the next day, Monday morning, saying that, okay, where is the performance? Because if you look at companies like us, we want to grow at a 30x CAGR, but unfortunately the growth today, because of whatever global reasons it may be, is not beyond 15 to 20 times. And that's what we were discussing earlier in the day, that growth today is a huge challenge across industries, especially for smaller companies as well.
Hi, myself Ankur. So I have a question for the VCs or PEs or the other So what would be the 5 factors that you would consider for say a new age startup co-founder or founder to invest in? So what would be the 5 tick boxes you would take in and say, hey, I'm going to invest into this startup company?
I think you are asking the investment thesis for us. But we come very early, right, where a lot of things are not there. So for us, if I have to choose, let's say 5 check boxes, I think out of 4 it will be the founders, who are the founders and what is their pedigree in terms of are they the founder product fit or what they are building. I think I leave it to that, because the rest all is a byproduct. Once you have the founders alignment with the investor, a lot of things fall into the place automatically. So we continue to invest in the founders and we will continue to do that.
One last question.
Just a continuation to that, they say it's 5% idea and 95% execution, so it's all about the person running the show. Is that true for investors?
100%. I think it's not even 95%, 100% are the same.
to, however, when it comes to deep tech, it is दिल को खुश रखने को गालिब ख्याल अच्छा है. So it's still a wait and watch game when it comes to deep tech and AI. But when it comes to the capital structure, probably we will invite a few more of our own, not taking inspiration from any other funds, but our own. And while we are doing it, we would have another few unicorns in India. So on that positive note, thank you Vizag, and thank you to the brilliant co-panelists here. Thank you so much.
Thank you, Purav, and thank you for conducting it so well. I think you were anecdotal and you engaged the audience so well. So a very, very big round of applause for the entire panel again. And one thing that I think we can take away is the repetition of the sentence, we invest in the founder. I think rather than hearing we invest in the company, we kept hearing we invest in the founder, and a very nice sentiment for us to be left with. Can I please request Kalyan to give the... Madhuri and Ravi Garu.